Have you ever wondered what caused the 2007 financial crisis? It was a time of great upheaval, affecting millions of lives across the globe. But what led to such a catastrophic event? Today, we're going to journey back in time and unravel the tale of this financial disaster. The year was 2001. The dot-com bubble had just burst, and the economy was starting to recover. To stimulate growth, the Federal Reserve lowered interest rates to 1%. This made borrowing cheap, and people were eager to take advantage. Banks began offering mortgages to just about anyone, even those with low incomes or poor credit scores. These risky loans were called subprime mortgages. However, the banks didn't shoulder the risk themselves. They bundled these risky mortgages into investment products called mortgage-backed securities and sold them to investors worldwide. In the mid-2000s, housing prices started to climb. This made those mortgage-backed securities look very attractive. But this was a bubble waiting to burst. By 2007, housing prices began to fall rapidly, and many homeowners found themselves in a precarious situation. They owed more on their mortgages than their homes were worth. This was the tipping point. As more and more homeowners defaulted on their loans, the mortgage-backed securities plummeted in value. Banks and investors who had bought these securities suddenly found themselves holding worthless assets. This led to a cascading effect, causing banks to fail and the stock market to crash. The 2007 financial crisis had begun, sending shockwaves throughout the world. Millions lost their homes, their jobs, and their savings. It was a grim reminder of the dangers of reckless lending and unchecked speculation. So, what have we learned from this journey through time? First, the allure of easy money can lead to risky behavior, both by individuals and institutions. The subprime mortgages and the subsequent selling of mortgage-backed securities were prime examples of this. Second, when the housing bubble burst, it revealed the true value of these risky investments, leading to a domino effect that brought down banks and crashed the stock market. Lastly, the effects of the crisis were far-reaching, affecting not just those directly involved in the housing and finance sectors, but people from all walks of life. The crisis served as a stark reminder of how interconnected our economy is and how the actions of a few can impact many. In the end, the 2007 financial crisis was a culmination of poor decision-making, greed, and a lack of regulation. It's a chapter in our history that we should not forget as we continue to shape our financial future. As we move forward, we must strive to learn from our past mistakes and work towards a more stable and equitable financial system. Remember, the economy is a complex machine, and it's up to all of us to ensure it runs smoothly. So stay informed, ask questions, and never stop learning.